Let's bring in Ari Wald. He's head of technical analysis at Oppenheimer. It's good to see you. I want your opinion on what I referenced earlier of Jonathan Krinsky suggesting, and I'm looking at my screen here, 3,900, sort of that line of support, that there appears to be support there. We're at 3,920 right now, and you could get a rally if, in fact, that number holds. Do you agree?
Jonathan does great work. I'm not having a view on 3,900. The level we're watching is 3,800. I think the point being here is where John and I are in agreement that near-term trading action, Scott, here is bearish. It's likely to get worse before it gets better. The key question we're asking ourselves is this a part of a basing process, or is this just the middle innings of an extended bear market that's got another year to go? And our work suggests that this could be the final flush that sets up the opportunity. So in terms of levels, we are looking at 3,800. Why 3,800? There's a bull market retracement of the 2020 to 2022 rise that shows up there. The May lows there. There was a July gap there as well. So I think that would be a logical place for the market to bottom. Seasonals are not in the favor yet for the market. I heard you quote the bespoke numbers for September. Those numbers are even worse when when September and the S&P 500 starts below the 200-day average. September, when that, under those circumstances, has only been higher 32% of the time, has averaged a 2.7% loss. The silver lining is that mean reversion typically occurs in October. Typically, when the S&P is below the 200-day average, that has been the best month of the year.
Not to say that 100 down S&P points won't feel painful, but I think most would say, well, if you're telling me that 3,800 is going to be this bottom, I'll take that. You suggesting we're not going back to the mid-June lows, which were 200 points below that.
Right. Yeah, I think I would take that as well. What I want to avoid is that extended bear market. What is the risk of that? The majority of bear markets, if you look at the post-war era, they're either long and shallow or short and sharp. We think this is the short and sharp variety. We've counted 4 extended bear markets. They occurred in 1968, 1970, 2000, and 2007. Our read of the tape is that market conditions are much stronger now than they were then, between internal breadth and credit spreads as well. Consider 2008, when the market was starting to turn lower from its 200-day average. At that point, banks were already at a new low. We don't have any sector at a new low just yet. So I think it's too early to presume that we're going to get that a much deeper reset below that June bottom, and why we still think there's a higher low scenario out there.